All right, welcome to The Explainer. Today we're jumping right into a super important topic for anyone looking to invest in the Pakistan Stock Exchange from overseas. Taxes. Let's get into it.
So you're a foreign national, and you're seeing some real opportunities on the Pakistan Stock Exchange. That's awesome. But before you dive in, there's one area you absolutely have to get your head around, and that's the tax situation.
You know, the goal here is pretty simple. We're going to cut through all the jargon and complexity. We're going to break down what can feel like a maze of rules into something clear and easy to manage, so you can invest with total confidence and zero nasty surprises. First things first, why is this such a big deal? Well, it's like any game, really. You can't play to win if you don't know the rules, and in investing, taxes are a fundamental part of the rulebook. Here's the bottom line. When you make a profit on the PSX, whether you're selling shares or getting paid dividends, those profits are taxable. The folks who set the rules are Pakistan's main tax authority, the Federal Board of Revenue, also known as the FBR. Now, before your eyes glaze over thinking about endless paperwork, let me give you some really good news. For you, the investor, the system is designed to be pretty much hands-off. Your bank or your brokerage, they handle most of the deductions automatically. You just need to be aware of what's going on behind the scenes. So, what exactly are we talking about here? When it comes to taxes for a foreign investor on the PSX, it really all boils down to three main types. Let's break them down. Okay, so here's the 30,000-foot view. You've got capital gains tax on your trading profits. You've got dividend tax on the profits the companies share with you, and then there's a withholding tax that can cover other things, like interest you earn. Now let's dive into what each of these really means. First up, capital gains tax, or CGT. This one's pretty simple in theory. If you sell your shares for more than you pay tax on that profit. But, and this is a big but, there's a crucial little detail you need to pay attention to. How long you actually owned those shares.
The rule of thumb for CGT is really straightforward. If you're a short-term trader buying and selling quickly, you're going to pay a higher tax rate on your profits. But if you hold on to your investments for longer, you get rewarded with a lower tax rate. It's a clear incentive to encourage long-term stable investment.
Next, we have the dividend tax. So when a company you've invested in does well, it might share some of that profit with you, its shareholder. That payment is a dividend. This is also taxed, but the process is super efficient. The tax is just automatically taken out before the dividend payment even reaches you. And finally, we've got this general withholding tax. Think of it as a bit of a catch-all. It applies to other money you might make that's tied to your investments, like, say, interest you earn on cash sitting in your account. And just like with dividends, it's all handed for you right at the source. Okay, so we know what the taxes are. Now let's get into the how, because this is where you'll see just how convenient and automated this whole system really is. The whole process really runs through your special convertible rupee account, your SCRA, and your brokerage firm. They're the dynamic duo. Together, they automatically calculate and deduct the right amount of tax from your transactions. Then they report it all directly to the FBR. And you just get these nice, clean statements showing exactly what was paid. It's a really smooth process.
So what this all means, and this is a huge sigh of relief for most people, is that because the system is so automated, the vast majority of foreign investors won't ever need to file a separate tax return in Pakistan. The only real exception is if you have other sources of income inside the country. If not, you're usually good to go.
All right, now we're going to shift gears a bit. We've covered the basics. Let's move into something a bit more strategic. This is a key advantage that every smart international investor needs to know about: how to avoid being taxed twice. This is where international treaties come into play. Pakistan has signed what are called double taxation agreements with lots of countries around the world. The whole point is to make sure you don't pay tax on the same income in both Pakistan and your home country. This could lead to a tax credit back home, or maybe even a lower tax rate in Pakistan to begin with. But, and I really have to emphasize this is not something you should try to figure out on your own. The rules are very specific for each country's treaty. You absolutely must talk to a professional tax advisor in your home country to see what benefits you can get and exactly how to claim them. We're almost there. To wrap it all up, let's go over a simple, practical checklist. Just think of this as your action plan to make sure you stay organized, informed, and totally confident as you invest. Okay, 3 simple things.
1. Be a good record keeper. Save all your trade confirmations and dividend slips. 2. Make it a habit to regularly download your capital gains tax statements from your brokerage. And 3. Stay in the loop. Tax laws can and do change, so keep an eye out for FBR announcements, especially before the new fiscal year starts in July. These simple habits make a world of difference.
And that's it. That's our complete guide to navigating taxes on your PSX investments as a foreign national. Now that you're armed with the knowledge, the system doesn't seem so intimidating, does it? So, the only question left is, with this clarity and confidence, what new opportunities are you ready to go out and explore?